Good morning, students. My name is C. Devas Gupta, and today we will be covering the topic of securitization. So, students, for securitization, although it being a theoretical chapter, a lot of theory is involved, but at the same time, it involves a lot of understanding as well. So, what I'm going to do is I'm going to run through the theory and the parallel conceptual understanding, and please do ask questions as you can because this would be a very new topic to all of you. So let us start with some background of securitization. Let me start with one small example. For example, Mr. A is a person who needs a housing loan because he have to go and purchase a house. So he needs a housing loan of, let's say, rupees 1 lakh. I'm assuming a very small number of rupees 1 lakh he needs as a housing loan. So what he is going to do is he's going to approach a bank. He will go to the bank and say, I need a housing loan for rupees 1 lakh because I have to purchase such and such property. And what bank will do? Bank will assess whether Mr. A is capable of repaying the loan back, plus is the actual value of the property rupees 1 lakh or more for whatever amount he's declaring that what is the value of property. After doing all those due diligence, bank will sanction a loan, right? Bank will sanction a loan, and Mr. A in return gives a promise to the bank that Mr. A will pay the interest as well as the principal repayments as and when they become due in the form of EMIs. Correct? So what bank does is bank grants loan to Mr. A. Similarly, Mr. A gives a promise or gives a commitment to repayment of principal plus interest, which I can say is nothing but the EMI. Correct? Now, if you understand it from the bank's perspective, so Mr. A is sorted. He got the amount, he purchased the house, and then he can enjoy the benefits. But if you understand from the bank's balance sheet perspective, so let's say this is the bank, and on the asset side, the bank will show us loans, and so basically housing loan is one of the asset that they have given amounting to rupees 1 lakh. Correct? This is what will appear on the asset side of the bank because this is an asset of bank. Now, what is the primary function of a bank? Primary function of a bank is to give loans and to accept deposits. Now, the moment bank is about to give another loan, so bank faces a issue of what if I term this loan is illiquid asset for a bank. Illiquid asset for the bank. Now, what is called as illiquid? Illiquid means which is low on liquidity. The cash flows are going to come to you over a period of time in future. Immediately, you can't go and convert this asset into cash. That is called as illiquid cash. So basically, in this loan, what Mr. A would promise to bank is, okay, he will pay the entire loan amount in 25 years. Correct? That's how it happens. So within 25 years, bank is going to get the principal as well as the interest amount. So hence, this 1 lakh rupees is illiquid asset for the bank. As of now, the bank cannot realize anything out of it. That is one. Second is, now as I said that bank wants to give further loans to further people or to further the people who require loan. So they also approach bank, and now bank is out of funds. So basically bank is facing a cash shortage, or I can say the funds shortage, because it needs to have a bank needs to have liquid assets so as to be given as a loan. Now what will happen here is, now there are two options with bank. One, borrow money. This is the safest and easiest option. Directly he can go, the bank can go and borrow further money. Now the bank will borrow at certain X percentage of rate, and once the money comes in, it can lend it as a housing loan again. Okay, that is one. But the moment bank do this, their ratios, specifically debt equity ratio or capital adequacy ratio, all these ratios will go for a toss, because higher the borrowing for a company or for a bank, higher the debt equity ratio, and once debt equity ratio is higher, that company is seen as a very risky company, because the presence of debt, the higher the debt in the capital structure, the higher the risk is. The risk of non-payment of interest, the risk of non-payment of principal. So hence, nobody prefers higher debt equity ratio. Correct? This is not what a bank prefers. So what another technique has come to the bank is, rather than borrowing money and increasing the liability side. So what you will do, once you borrow, the liability side will increase. So rather than doing that, what banks does is, banks transfer this housing loan to another company, and it will realize the cash. Today means once the loan is sanctioned and once the loan is given. So what bank will do is, bank will approach a company, let's say company XYZ. With this company, bank will say, okay, I have a housing loan sitting in my asset that gives me a right to receive interest and principal from Mr. A. Why don't you do one thing? I'm transferring you my right, and after I've transferred you my right, all the future cash flows you can accept. It's just that the current loan of 1 lakh rupees, you give it to me, so that for me, the cash will come from XYZ company and I can lend it to someone else also. That's how the bank will grow its business. So what they will enter into an arrangement here is, so let me put it in the next slide. I'm just putting it here as, to XYZ company for transferring the loan. Okay, now I will go to the next slide and prepare it in a proper chart. So we have studied that we are talking about a loan which is a housing loan. So students, if you note, once the bank gives you a housing loan, bank will keep all the mortgage papers. All the papers it will keep as a mortgage, as a security. Once you return the entire principal along with all the interest payments due, bank will return you the mortgage papers, or bank will return you the original papers. That's how happens to the housing loan. So in technical term, now I'm coming to the technical terminology. In technical terms, this loan, which is a housing loan, so housing loan is also called as mortgage loan. Why? Because it is backed by a mortgage security. So the housing loan is also called as mortgage loan, or simply we can also say that it is a mortgage. Okay, it's simply a mortgage. Now let me put properly the chart here. So there is a bank, and here is Mr. A. So between bank and Mr. A, this mortgage loan is given. Mortgage loan is given. Correct? Bank will give to Mr. A mortgage loan. In return, Mr. A will pay to the bank repayment plus interest. This is repayment of principal. Okay, students. Similarly, bank apart from Mr. A would also have Mr. B as a loan, Mr. C. Likewise, thousands of borrowers will be there. Correct? There will be thousands of borrowers. So I am saying, let's say 1,000 borrowers have taken 1 lakh rupees of loan each for housing purpose. So the overall portfolio of loan, portfolio here means collection of loans, right? Overall collection of mortgage loan is equal to, this is 10 crores. So currently the bank have given 1 lakh rupees each to 1,000 borrowers like Mr. A, Mr. B, Mr. C, and that total value is rupees 10 crore. Now what bank will say, okay, now I have already given 10 crores, but I am running out of cash now, and hence even I cannot go and borrow because already my debt equity is higher, my capital adequacy ratio is also not that good. So what I'm going to do is, let me do one thing, let me opt for the transferring of this loans. So I'm just putting here, this is called as illiquid assets. This is called as illiquid asset for a bank. Because this don't offer the immediate liquidity to the bank, correct? It has its own repayment schedule. So what will happen is bank will go to a company called, let's say XYZ company in our previous case. I'm just removing the word company here. It can be in any legal form. Okay, that I'll explain it later. This XYZ part I'll explain later. But as of now, you understand that XYZ is a separate entity. Okay, it's a separate entity. What bank will go and ask to XYZ is, see XYZ, I have a portfolio of mortgage loans amounting to 10 crores. Why don't you do one thing? You give me 10 crores upfront, and I will pass on the right to receive repayment of principal and interest to you. Because what is loan? Loan, essentially, it means that it is a right to receive interest and principal. And currently, this right is with whom? This right is with bank currently. So what bank says is that to receive the interest and principal on the loan, I will transfer you the right and you give me the money today. So what XYZ will do to the bank is, XYZ says, okay, I will pay you rupees 10 crore today, and bank will transfer the right. Transfer the right to receive interest and principal. In a very simple and plain language, bank will sell its assets to XYZ because this loan is an asset for the bank, correct? So bank will transfer its assets to XYZ and it will receive the amount. Now, how XYZ will fund this payment? Because for XYZ also, because if XYZ is also not having or holding the cash or funds in their hand, now how XYZ is going to handle this transaction? So what XYZ will say is that let me approach some group investors, some of the investors who would be interested in investing this kind of a venture. Now, what kind of a venture XYZ is? XYZ is holding the right to receive interest and payment, correct? That now currently it is with whom? Currently it's with XYZ. Now they hold it. That means in future the cash flows is going to come to XYZ. So what XYZ will go and propose to the investors, to the future investors, is that okay, I will issue you my securities. I will issue you my securities. You hold them securities and you pay me certain amount depending on the denomination and the value of security. And once we keep on receiving the repayment of interest, repayment of principal and interest, I will pay you we will settle the security amount to you in future, basically. Okay. So what this XYZ is going to do is it is going to issue some securities. Now here comes the investors. Because XYZ also would not have funds, right? So XYZ would also approach some investors to whom XYZ will say that, okay, I am issuing you a security, issuing securities. Then investors will invest in XYZ, basically invest in securities, basically. Correct? So or I can say that they will pay the amount to XYZ for the security purchase. So Sairam, let me come to your question. Let us first understand the entire part of it. Okay. So XYZ approaches the investors. Investors are issued with some securities, and investors will pay the amount back to XYZ. Okay. Now with this, XYZ will collect 10 crores again. Correct? XYZ have collected back 10 crores, which XYZ has paid to the bank, and bank has paid to the group of borrowers like Mr. A, Mr. B, Mr. C, to all of them. Now, talking about these securities, so these securities are issued by XYZ on the backing of what? What is the backing here? The backing here is the mortgage loan. Correct? The backing here is what? The mortgage loan, because bank transfers that mortgage loan to XYZ, and XYZ is issuing securities basis that backing of mortgage loans. Hence, we call these securities, technically we call these securities as mortgage backed securities. I hope very easy for all of you to understand this. This is called as mortgage-backed securities. Why? Because these securities are issued on the backing of a mortgage loan, which the bank has paid to a lot of borrowers and bank has transferred to XYZ. Correct? And as I told that, housing loan is also called as mortgage loan. So these securities are called as mortgage-backed securities. Plus, these securities also gives an advantage that these are marketable securities. How these are marketable securities is, now one can go and market them. So basically, now let's say there is an investor. Okay, let me further take this investor. Now, who are these investors? Now, these investors are not like you and me. These are not retail investors. These are big institutional investors. For example, pension funds, who are cash rich, who manages a lot of funds. So all the pension funds can see this as an investor. All the mutual funds, they are cash rich, right? They are managing the funds. They have to invest. And while investing, they can be one of them. Even the banks also can be investor. Let's say this is bank A, but this can be some other bank who is investing in this portfolio of mortgage-backed securities, right? So these can be ones, and it can be like other institutional investors as well. Okay. So these can be anything. I mean, these can be from the big investors, and what they do with this security, which is the mortgage backed security, these marketable securities, is today they get issued this security from XYZ, but tomorrow, if they are not happy with or they have to exit this investment, they can easily go and sell this security to some other person. So hence, these are marketable securities. Correct? These are marketable securities. Marketable securities. Okay, students. So now if you see the entire process that I have listed down here, okay, what has eventually happened? What has eventually happened? The transaction originated from this illiquid asset, which is giving of a mortgage loan. On the back end, bank have gone and contracted that to XYZ that I will transfer you all the loan. You give me the current money today. And what XYZ says is, okay, even I have to raise some funds. I will go and approach investors, take money from them. So, in effect, the money has been channelized from investors to XYZ to bank to Mr. A and to other 9,999 borrowers apart from Mr. A. Correct? That means this is the channel of money. And what has happened is this loan, the portfolio of mortgage loan of this 10 crore has been securitized. Securitized means the respective securities has been issued. Securitized means here this process of issuing the marketable securities, this one from XYZ to investors, this process I'm saying, this is called as issuing of securities, and hence the mortgage loan is securitized here. And this entire process of converting the illiquid asset to marketable securities is called as securitization. Students, please listen to each and every discussion very carefully, because everything is dependent on the very basic things that I'm starting with. Okay? Please do ask as many questions as you can. Now, Sairam is asking, it's like in what of business, post-dated checks are given to one person and that person given payment of that check amount after deducting some commission. No, so Sairam, basically that if, what I understand is in case of what of business, post-dated checks are given as a security for payment, so that tomorrow the person would not go and run. Still the payment is coming on the due date, correct? Because let's say why post-dated check they are issuing is, let's say today I am selling some goods, and after selling the goods, the amount becomes due 30 days from today. So the post-dated check will carry a date of 30 days from today. Still the payment you will get will be in next 30 days, correct? But here what we are saying is, here the transactions are very complex. What we are saying is that bank will agree with XYZ that today it will receive the money, which bank is entitled to receive in next 25 years. Can you see the difference? As I mentioned, yeah, as I mentioned that the tenure of this loan is how much? 25 years. So in this, if the bank would have not done the transfer to XYZ, still the bank would have got the amount in 25 years. So what we are talking about is how to reduce that 25 years to day zero today. Today itself, the bank will get the 10 crores from XYZ. Okay. Now let us go to the exact introduction part. The process of securitization typically involves the creation of pool of assets. Pool of assets was created as rupees 10 crore in our example. Correct, students? It was created as rupees 10 crore, which is nothing but 1,000 borrowers multiplied by rupees 1 lakh of loan, housing loan. Correct? So that is pool of asset. It involves creation of pool asset from the illiquid financial assets. So this mortgage loan is a illiquid financial asset. So all the illiquid financial assets are formed as a pool, such as receivables or loans, which are marketable. Correct? In other words, it is the process of repackaging or rebundling of illiquid assets into the marketable securities. See, students, mark all these words which we have now understood what is the meaning of it. So, what we are doing is illiquid assets is converted into marketable securities. That is what we have studied from the previous chart. And what essentially this repacking or rebundling means. See, students, if you see in the example that we have taken, what is being done here is Mr. A's loan. Similarly, Mr. A, Mr. B, all the 1,000 borrowers' loan is bundled together. Instead, now if we use a technical term, so we say that it is bundled together. That is used commonly here. So bundling. So this is called as bundling. We are bundling all of them, and that bundle is of 10 crores now. Correct? Because the loan value within those bundles is 10 crores. Okay. These assets can be automobile loans, credit card receivables, residential mortgages. This is what we have just now studied. We have studied this one type of loan, residential mortgages, in our case study. Okay. Even the credit card receivables also can be done, and even the automobile loans or any other form of future receivables. Any other form of future receivables can be pooled together, bundled together, packed together, and those will be illiquid assets, and that will be converted to the marketable securities. So what we are talking about here is that we have a illiquid assets. We are creating a pool of such assets. Once the pool is created, through the entire process, through bank, XYZ, and investors, all of them in loop, there is a marketable securities that gets created. And these marketable securities, for example, there is a 10 crore, right? For investors to pay to XYZ, there is a total amount of 10 crore. Now, for example, marketable securities will be in denomination, correct? Just like we issue equity shares, 10 rupees face value each multiplied by the number of shares, that becomes the total capital. That's how it is going to be here as well. For 10 crores, for example, the 1 unit of security is 1 unit of securities, I am assuming, let's say 100 rupees, correct? So that means 10 lakh securities numbers to be issued. Correct? Now these 10 lakhs can be held by pension funds, mutual funds, banks, and institutional investors, who will invest in this 10 lakh securities. So because each one of is 100 and multiplied by 10 lakh, there how it is 10 crore is going to come. Okay, so marketable securities, I am supposing it 10 lakh numbers multiplied by 100. Correct? So this pool of 10 crore of loan is converted into these much of securities. Okay, students? So this is what the process of securitization is. Naveen is asking only financial assets. So InvIT. So basically, Naveen, if you go with the plain definition, it says that, see, what is a financial asset or a financial liability or a financial instrument which gives you a right to receive cash in future, correct? So in case of any investment which gives you a right to receive cash, then it will be considered as a financial asset, and hence that can be restructured into the securities of using the concept of securitization. Okay, Naveen? Even for InvIT also, if it allows or if it entitles the holder to receive in cash. The future cash flows are going to come in cash. Okay. Now let us go back to this discussion again. Now students, I am also now putting some terminologies here. So the group of all the borrowers here, the 1,000 borrowers that are there, Mr. A, Mr. B, Mr. C, like that, they all collectively termed as borrowers. There is nothing new in this. These they are called as borrowers only, correct? And this is one. Second is the bank we are talking about in this technical terms is called as originator. Because bank is the one who has originated the transaction, hence it is called as originator. Okay, this XYZ company. Now one more thing, this originator can be anyone. It can be NBFC also, it can be a bank also, it can be anyone who has some kind of a receivable in the form of financial asset. For example, any company which even have some receivables also that are going to come as per the terms and conditions agreed between the company and the borrowers. So then all those who are undergoing the securitization are called as originator. Correct? Not even bank, but in my case, I have taken the example of bank. This is what originator is. Then this XYZ is what? Is a SPV, special purpose vehicle. Technically, we call it as SPV, special purpose vehicle. Now, going forward, I will be using these terms only in my discussion. I will be using borrower, originator, SPV. Okay. Now, SPV is special purpose vehicle. So, what does this mean? Okay. Now, let me elaborate this SPV here. SPV is special purpose vehicle. Now, this special purpose vehicle can be in the form of what legal form it can take. It can be a company. It can be a limited liability partnership. It can be a normal partnership. It can be a trust. It can go as a trust as well. Or it can take any legal form. That depends on the person who is creating this SPV. Okay. This is SPV. And fourth one are investors who are called as investors only. So there is no other name for these investors. So these are called as investors only. So Rohita is asking, good morning, whether securitization is done only by banks or even other. So Rohita, just now I answered that. See, securitization, which means the originator can be the bank or it can be anyone which have some kind of a future receivable to receive. Okay, Rohita. Students, again, I'm saying please do ask a lot of questions because this topic is very interesting and very new to all. And this is the concept of today. Okay, students. So SPV is there and then the investors are there. Now let us introduce some kind of complications here, complexities here. Okay. Because that is the thing that will make our understanding very, very clear. Because in all of your mind also there would be lot of things that would be coming, that why will entire this thing will happen, what is the genesis of this. Okay, now let us try to decipher each and every point in a very detailed manner. Let me go and check the PPT. What is the next slide? Okay, let's see the features here. Okay, let's see the features here. Now, what are the features of securitization? All these things I have taken strictly from the study material, and all the topics, respective topics, are easily convertible into questions. For example, in examination, the question can come, what are the features of a securitization? So all these specific points are taken from the study material only. Sairam is asking, securitization is applicable only long term. Sairam, that is directionally, if you ask me, yes, because that is why the organizations will go into the securitization. But medium term also it can work, and short term also it can work. It depends how fast you need the money or how conveniently you need the money. But directionally, if you ask me, yes, it is for long term only. Now, features of securitization are that are given in the study material is creation of financial instrument. So first of all, students, if you see what has happened is the illiquid assets are converted into the marketable securities. Illiquid assets are converted into marketable securities. These marketable securities are also financial instruments. Why? Because it gives the holder, who is the investor, right to receive cash flows in future. So these marketable securities give the right to investor to receive cash flows in future. Hence, from the investor's point of view, these marketable securities are also financial instruments. And even from XYZ, which is SPV's point of view, these securities that are created are creation of financial instruments. So creation of additional financial product of securities in market backed by collaterals. See, they are also using the same term, market backed by collaterals. What we have said is these are mortgage backed securities, the same term that I referred while relating to that. Mortgage backed securities is because the backing of these instruments is mortgage that has been given to a lot of borrowers. Now, the second feature here is bundling and unbundling. Now, students, bundling we have already studied. Bundling means creation of the pool of assets. While we take all the assets, all the 10 crore rupees worth of asset into one pool of asset, that is called as bundling. Now, what is called as unbundling? Unbundling is the issuing of securities of fixed denomination, because now with that pool of assets, see, first of all, we have done a bundling here. Bundling is nothing but creation of pool of assets. Now, once these assets are created, these are converted into marketable securities, correct? So those marketable, the process of issuing marketable securities, so that means 10 lakh securities of 100 each we have issued, correct? So this is called as unbundling, because here we are creating different securities, and hence we are unbundling it. So basically assets are combined in one pool and then broken into instruments of fixed denomination. Okay, so first part done, second part done. Now there comes the next part. Students, please pay attention here again. Now, generally, if you see how the industry works around it is, now there is an originator. Now I am going to use the terms that are I have already specified, correct? Because those are the terms of securitization. So hence we should shift our discussion from bank to originator now. So originator, while selling or while transferring the loans to SPV, special purpose vehicle, one is on a recourse basis and second one is on a non-recourse basis. What is the meaning of recourse and non-recourse? See, the recourse means that tomorrow, if any one of the borrower fails or defaults either for interest or for principal repayment. So if there is any kind of default from any of the borrower, if there is a recourse, then SPV will not be able to realize the cash, correct? So if there is a recourse kind of arrangement, then SPV will go back to the originator and ask for the money. So there is a recourse available with SPV to go and ask originator to pay the amount in case borrowers are defaulting. I hope recourse basis is clear. So recourse would allow SPV to get funds from originator in case a borrower defaults. In case a borrower defaults, SPV has full rights to go to the originator and ask for the money back. However, in case of a non-recourse basis, SPV don't have any right to go and ask for the funds back from the originator. Why? Because in this case, that's how the agreement is between originator and SPV. SPV is not entitled to go back and ask the originator to pay the default, to make good the default made by any borrower. So in this case, no entitlement to the SPV to get funds back from originator. Very easy, very simple. I think the same recourse and non-recourse you would have studied earlier also in some other topic. Even if not, then also these are very easy. So recourse means that yes, there is a recourse available. Non-recourse means that there is no recourse available, and hence all the losses has to be borne by SPV. In case of a recourse, if there is any default by any borrower, then SPV has a right to go and claim the amount from originator. Okay, students. Now, where do you feel is the risk getting mitigated from originator? So risk mitigation is happening at originator's end in case of a non-recourse instrument, correct? In case of a non-recourse arrangement. So tools of risk management says that non-recourse basis acts as a risk management as the risk of default is shifted. Very easy, very simple. Just try to understand each and every word in what the essence it is trying to say. Definitely it will act as a tool of risk management for whom? For the originator. So we are talking this from the point of view of originator. Okay, students. As the risk of default is shifted. Okay, now what is the fourth point? Structured finance. Now, why we are saying structured finance? Because there is a proper structure. There are 10 lakh securities of 100 each. This is a structured instrument. Correct? So these financial instruments are tailor structured to meet the risk and return trade of the profile of the investor. Now, this financial instrument will say that if you are investing 10 lakh, there are 10 lakh worth of securities available multiplied by 100. So there is a 10 crore worth of securities available. And on those 10 crore securities available, the SPV will pay to the investors an interest of around 10% per annum. And there is a risk of default by around 20%. So this is what the risk and return is also given in the financial instrument while those are issued to the investor. So hence it is a structured finance. Now, for the following 2 points, trenching and homogeneity, I have to go back and give you some other example. So what we can do is this trenching and homogeneity, let's keep it for the last part of the session. We will cover it in the last part. Okay. Because this will first I have to develop some other kind of understanding. So then we will do the trenching. Okay. Yeah. So Pradeep is asking originator means. Okay, Pradeep, as I have put in this chart, originator is the one who initiates the transaction, who origins the transaction. Transaction of what? Transaction of illiquid assets, or the transaction of mortgage loan, or the transaction of any other receivable. In this example, the originator is a bank. It can be an NBFC also, it can be anyone else as well. Okay, Pradeep, this is what we have studied in the initial part of the session. Siva Saptagiri Rajesh is asking, good morning. So all marketable securities cash flow be discounted, though they are accounts receivable, and security is the only option available with any originator for cash liquidity or any other arrangement available. So Siva, like this securitization, as you rightly said, the discounting will happen on the future cash flows, and hence the current prices can be determined. Although apart from securitization, there can be other instruments also available with them. But where the securitization has come into play is if you have some given problem, and that problem also what we have studied is that bank needs further money. It can't go and borrow because it will raise the debt equity. Hence, there is another way of borrowing, or let's say off balance sheet financing, which is the securitization. Okay, Siva? There are other arrangements available. Definitely, they can go and easily borrow it. Correct? So Rohita is asking, sir, will SPV take illiquid assets only if regular payments are received by originator at the point of time, or even if irregular payments at the beginning itself? Okay. So Rohita, let me come to your question on the regular and the irregular payments while we cover the type of securities, whether pay through certificate or pass through certificates or pay through securities. So in that, Rohita, I will take up your query. Okay. Whether we are talking about the regular payments or irregular payments. So basically what I'm trying to what I've understood, Rohita, in your query is that you are asking whether if the payments are regular, then also we can do the securitization. If the payments are irregular, then also we can do the securitization. Okay, Rohita. Why? Because now you will say that why will a SPV accept a irregular payment kind of a situation? Correct. So in that case, SPV, since it is acting on a high risky portfolio of the asset, so it will also charge the higher fees, the higher return. Correct. The investors will also expect a higher return. Correct. So it all depends on the risk and return profile of the investor. Okay, Rohita. But yes, the securitization will happen in both the instances, whether it is regular or whether it is irregular. Okay. Naveen is asking, securitization will always be non-course. No, Naveen. It can be on non-recourse or it can be on recourse also. It is always based on the agreement between both of them. If it is on a recourse, that means originator will try to price it at a lower end. If it is on a non-recourse, correct? No, sorry. If it is on a recourse, then originator will try to get good amount of discount from SPV, because SPV has the option to go back to the originator in case of a recourse. In case of a non-recourse, originator will be able to pay higher amount. I mean, he will let go the discount that SPV can offer to him. So the pricing will depend accordingly. Okay, Naveen? Now, Sairam is asking, the originator is transferring only the right to receive from borrower to SPV. That's correct, Sairam. Because what is loan? Loan is nothing but the right to receive, right? If it is a right to receive, then only it makes a case for the SPV to purchase it. So that means it is transferring the loan itself. Correct, Sairam? Now, Siva Saptagiri Rajesh is asking, could you please give a small example to differentiate recourse and non-recourse basis? Okay, Siva. Okay, Siva, let me give this example. Now, in this only, Let me say it like this. Now, all the students, please listen very carefully. Continuing in my previous example, I have mentioned that there is a 10 crore rupees worth of pool of assets that is held by 1,000 borrowers. Okay, this is what the mortgage was. This is what the mortgage was. Now, within this mortgage, basis all the permutation combinations, we know that 20% of the borrowers will default, because there will be a proper evaluation of these borrowers. What is the paying capacity of the borrowers? What are the cash flows that borrowers are also earning? They will go in each and every depth. So by that study, they will come to know that, okay, 20% of the total borrowers will default. And they will also come to a conclusion that if a borrower defaults, only 50% of the amount is received. Only 50% of the amount will be received. Okay. So in case 20% of the borrowers will default, that means within those 20% also, they will still be able to give us 50% of the amount. 50% is what they will default totally. So what I can say is, out of this 10 crore multiplied by 20% multiplied by 50%, what is the amount of default? So basically 10 crore multiplied by 20% multiplied by 50%. So which is 10% itself. 10% on 10 crore comes out to be 1 crore. So we are talking about here a default of rupees 1 crore. That means 1 crore amount of principal and the equivalent interest on that principal will not be recovered by SPV. The borrowers will not be able to pay to the SPV. Now what will happen is, if it is a recourse basis, I am talking about 1 and 2 here, correct? So 1, if it is a recourse basis, there is an option available with SPV to go and claim this 1 crore of principal plus interest on this 1 crore also, because the borrowers will not either pay the interest on this 1 crore and they will also not pay the principal. Okay, so recourse basis 1 crore of principal plus interest on 1 crore can be recovered from originator. Okay. Second, non-recourse basis. No recovery from anywhere. There is no recovery from anywhere. It's just that there is a dead loss. That's all. I will take these specific cases further into my discussion. Okay. Actually, there is no dead loss. See, now SPV is also very smart. What they will do is, they will also go and take some kind of insurance. Okay, I will bring all those further things into my discussion. But as of now, basis the understanding on recourse and non-recourse, what is I'm trying to say is that recourse, there is an option available to recover it back. Non-recourse, there is no option at all. Okay. Siva, I hope I am able to give you an example on recourse and non-recourse. Sairam is asking, means any mortgage documents are not transferred to SPV? No. See, mortgage that actually, Sairam, depends on the agreement between both of them. Correct, between originator and SPV. Now, if they decide that that actually the mortgage documents also should be transferred to the SPV, then it will be transferred, otherwise it will be not. So those are all depending on the mutual things, on the negotiation powers between both of them, how well both of them are structured or how well both of them are placed in the market. Let us, because our purpose is to read the standard ways of working between both of them. Okay, now let me come back to the same slide again. Okay, now students, again, please note, now I'm using the technical terms here, and we will again try to see the chart here. Now we will introduce some more elements. So there are these borrowers. Okay. Then there is a originator. Very interesting and very new concept actually. So this is the originator. These are the borrowers. And here, as we said, is the SPV. Till now, we have studied that there is a transaction between borrower and a bank on the sanctioning of loan, which is the mortgage loan. Okay. So that means between originator and borrower, there is a transaction that has already happened. And between originator to SPV, the transfer of loan has also happened. Okay. Till here, we have already studied in the above discussions that this has already happened. Now, what is the next step? Next step is SPV is going to issue the securities to the investors. Correct? That was our next step. But here comes the issue now. Before they issue the securities here, issue of securities, don't you feel, if you are in place of the investor, don't you feel that you would also need some kind of a security? I mean, security means the some kind of sense of security that your investments are safe. From that point of I'm asking, and you would also need to know that what is the quality of these mortgage loans. Quality of mortgage loan means what is the paying capacity of the borrower, what is the value of the underlying mortgage that is there, that is the value of property. So those all questions will come to your mind, because as an investor, because I told you who are these investors. These investors are mutual funds, pension funds, who are very rich in cash. So what they want to properly ascertain is whether the venture in which, or the SPV in which they are going to invest, the asset quality of that SPV, which is these mortgage loans, which are these mortgage loans, what is the quality of that asset? So that quality evaluation is technically called as credit rating. Correct? So these investors will go and seek the credit rating. They will ask SPV itself to go and do the credit rating of the pool of these assets. So there is now third agency. There is a new agency here, the credit agency. The purpose or the role of this credit agency is to comment upon the quality of the assets that SPV holds. So they will issue a credit rating. Credit rating. Now, credit rating, let's say they issue a AAA credit rating. They say that this investment is very, very good. There is no chances of default. All the valuations are correct. The underlying are properly secured. The underlying valuation are properly secured. That means investors can go ahead and invest in this. So this will build some confidence in the investor that, okay, I am okay to invest here. Okay. And hence the issue of securities will happen and investors will invest. Now, what will happen once the securitization is done? The illiquid assets are converted into these securities. Illiquid assets are these mortgage loans, and these marketable securities are these securities. Once this has happened, then what will happen is borrower will have to pay their regular EMIs. Let's say after 1 month, 2 months, 3 months, till 25 years, because I am taking an example of 25 years here. So till 25 years, borrowers will continue to pay their EMI. So what they are going to do is they are going to repayment plus interest payment. They will continue to do this. Now, since the asset is already transferred, the loan is already transferred to SPV. So the entitlement to receive these amounts, the repayments as well as the interest, both of them is also transferred to SPV, because as I said that what is loan? Loan is the right to receive the interest and repayment, correct? And for this, now who will at the first instance receive the collections? The collections will be received by a party called receiving and paying agent. This is a new agent that again we have introduced here. So there is an agent who is called as receiving and paying agent. Now, who will adopt this agent? Originator will adopt this agent. Practically, originator himself is the receiving and paying agent, or he will adopt a receiving and paying agent. Now, what is the role of receiving and paying agent? Is to collect the amount from borrower and then pay it to the SPV. It will receive and it will pay. Okay, because the proceeds will not go to the originator. Why? Because originator have already got the proceeds at the time of transfer of loan. Now anything which borrowers repays or pays as an interest, it will go to the receiving and paying agent, which is originator himself or an agent of originator appointed by originator, and then finally it will go to the SPV. Now what SPV will do after receiving it? Once SPV receives it from the receiving and paying agent, it will settle the securities. It will pay back to the investors. Pay back to the investors after reducing their management fee or their operational expenses, correct? Because SPV is also not doing any charity. They will also make out their operational expenses and their profit margins. After removing everything, they will pay back to the investors. All those things are properly agreed earlier itself before the thing. Now, one more thing. For managing this SPV, because SPV in itself has to be managed by someone. And as I told you that SPV can be in the form of a company, a trust, a firm, a LLP, anything, correct? So who are the real people who manages the SPVs are trustees, basically, correct? There are trustees who will oversee the entire functioning of the SPV. So they will oversee the entire functioning of SPVs, correct? And the very last point, which is actually practically a very practical point I'm saying. Now, in this entire arrangement, who is bearing the highest risk? Who is bearing the highest risk? The highest risk is borne by investors here. Okay. Why? Because investors are the ones whose money is channelized to the borrower, correct? Investors' money is going to SPV, SPV is paying to originator, originator is paying to the borrower. And what investors have as a security? Investors have underlying mortgage as a security. But what can happen is, maybe this credit agency have also given their report on the credit rating, but still what investors feel is that apart from the credit agency, the credit rating has been given, but still we are still the highest in terms of risk. Why? Because tomorrow if the mortgage goes on default by any of the borrower, which even credit agency is not able to predict, then our funds are gone, correct? Hence, there is a concept called as credit enhancement, or there is another agent to the picture which is called as credit enhancer. Now, what is the role of these credit enhancers? So, as I told you that since these are mortgage loans, the underlying security here is the house itself, correct? Because tomorrow if the borrower is not able to repay, bank will go or the agent will go there, they will take over the keys, sell the house, realize the amount and realize the principal. and the interest charges thereon. But what if the house value actually is very low? For example, a loan of 1 lakh, as per our earlier example, ideally the house value should be at least 1 lakh or higher, correct? Then only it is covered. But what if falsely the house value is only 50,000? Then what will happen is there is no security of this 50,000 that is left. Now, what the role of credit enhancer is, credit enhancer will give the guarantee in case the SPV is not able to realize any money from the borrower. Okay, so credit enhancer will give a guarantee to make default good. It is just like a insurance. How insurance works? If SPV incurs a loss means they are not able to receive back the repayment plus interest because borrower has gone bad and the mortgage also doesn't covers the full value. Then credit enhancer is sitting and it will make good the default. It will pay 50,000 from its own end. And in return, credit enhancer obviously charge, just like insurance premium is given, this credit enhancer also charges its own commission. Very simple, very easy. This credit enhancer, what it is going to do is, it is going to give you a guarantee that your investments are secured. Tomorrow, in case there is a default, I am sitting to make up for that. This is what the role of credit enhancer is. And hence, now the entire risk is transferred from investors to the credit enhancers, because now the ultimate risks are taken by the credit enhancer. I hope this discussion is clear. So coming back to the questions, Siva is asking, thank you sir. So recourse option is beneficial to SPVs. Definitely yes, recourse option is beneficial to SPVs because they have a recourse back to the originator. But in case of non-recourse option also now, Siva, we have studied that since there is a credit enhancer who is sitting here, whose role is to make good in case of any default. Hence, in case of non-recourse also, there is no issue as such. Now, what SPV has to do is, SPV has to do a cost-benefit analysis between what cost it is going to pay to the credit enhancer and what is the discount or what is the extra amount that he is getting in case of a non-recourse, or what is the risk basically there, correct? Then they can decide whether to go ahead on a recourse or a non-recourse basis. Sairam is asking, SPV is mentioning the reason for raising funds from investors. Definitely yes. SPV has to declare a lot of things to the investors. What is the, see, this any which ways, one disclosure will come from SPV itself on the quality, on the creation of the assets, on the pool of assets, how does it looks like, who are the borrowers, what is the originator, correct, what are the type of loans, what is the interest rate, maturity, everything will come and be disclosed to the investor. And on that, there will be a credit rating agency also, which will issue a proper report on the quality of those assets. Okay. Everything will happen in a very transparent and fair manner. Otherwise, who is going to invest in the entire thing? Okay, students. So now let us go back and see what we have studied. As I told you, this trenching and homogeneity, I'm keeping for the last part of the session. We will cover that. Rest 4 points we have already covered. Now let us come to the participants in securitization. This also we have already studied. Now let us just try to see what are the main points around it. So there are two types of participants. One is the primary participants and one is the secondary participants. Why do we call them primary and secondary? Is because primary are the ones who are actually involved in the transaction, who are involved in the giving and taking of cash. Cash means the funds. And secondary are those who help in executing the entire thing. Now, who is the biggest primary participant? Definitely originator, because if originator is not there, that means there is no mortgage loan, there is no other loan, and hence there is no need to securitize also. But since originator is there, so it is an entity which sells assets lying in its books and receives the fund generated through the sale of such assets. This is what we have already discussed. The originator transfers both legal as well as beneficial interest to the special purpose vehicle. Beneficial interest is what? Right to receive funds, right to receive interest and principal repayments on the loan. Correct? This is what the beneficial interest is. Legal is that tomorrow the legal recovery, if borrower is not able to pay, the legal recovery stands good in the hands of SPV. Correct? So hence the legal rights are also transferred. Originator is one of the participants. Then second comes as special purpose vehicle. SPV is now, the name itself suggests that special purpose vehicle is, it is only created for one specific purpose. What is that purpose? To execute the entire securitization. They will issue the marketable securities and get the repayments back. SPV is created for the purpose of executing the deal. Since issuer, originator, the issuer who is the originator transfers all rights in assets. See students, I am also talking about the same language right from the starting of the session. The right in assets, that means the right to receive interest and the principal repayment. This is what my starting slide also says. To SPV, it holds the legal title of these assets. It is created normally in the form of a company. As I told you, it can be company, firm, society, trust, and it is designed specifically for the purpose of securitization. Further, it also issues the securities, which are called as mortgage-backed securities. Okay, this we have already discussed. What is a mortgage-backed securities? In case there is no mortgage, then and there are other assets that are involved. What are the backing? The backing is our asset-backed securities. Okay, one and the same thing. Let me go to the first slide, the second slide here. We have studied these are the mortgage-backed securities. These are issued by X. These were issued by XYZ to investors. XYZ was SPV in our example. Okay, students. This is what SPV is going to do. Now, what are the now the third primary participant is investor, because there has to be originator, there has to be SPV, and there has to be the persons who are going to invest. Now, investors are the buyers of securitized papers, which is nothing but the marketable securities, the securitization, which may be, sorry. Yeah, are the buyers of securitized papers, which may be an individual, an institutional investor, such as mutual fund, provident fund, insurance companies, financial institutions, etc. They receive their money back in the form of interest and principal as per the terms agreed. They will receive back the money from SPV once the SPV receives back the monies from investors. Okay, this is what the primary participants are. Now let us go to the secondary participants. Sairam is asking what type of security is issued by SPV. Sairam, we will cover that in our session. There are three types of securities. We will cover them, all of them in detail. Okay. Now, who are the participants? Obliger is a obliger or borrower basically. Obligers are borrowers only. So parties who owe money to the firm and are assets in the balance sheet of originator. These are the parties who borrow from the originator and they are the assets. The amount due from obliger is transferred to SPV, hence they form the basis of securitization process, and their credit standing is of paramount importance in the whole process. Correct? These are the borrowers. Now the rating agencies are those which we have already studied. They will have to assess in terms of its credit quality. What is the quality of the credit or the asset that is there and the credit support available. Rating agencies, they will assess what is the strength of cash flows, how the cash flows, although there is an estimation to cash flows, but what is the strength to actually those cash flows happening. Mechanism to ensure timely payment of interest and principal repayment, credit quality, liquidity support, and strength of legal framework. Although rating agency is secondary to the process, but it plays a very vital role, because without it being there, investor will not get any confidence to invest in the securities issued by the SPV. Correct? Apart from that, we also studied that there is a receiving and paying agent whose responsibility is to collect the collections and pay it to the SPV. Then there is an agent or trustee who's appointed to oversee all the projects that are performed by the SPV. Correct? Then credit enhancer. This also acts as an insurer. It ensures the default in case is done by the borrower, and it is provides good backing to the SPV and hence to the investor to invest in the entire proposition. Then there are structurers. The last point that is left in the parties is the structurer. Now let me go back here. Who are the structurers? See, students, now we have studied this, right? This covers our all the parties, including the credit enhancer. Now, who are the structurers? Structurers are those who brings all these people, all these parties onto a table and execute the deal. Structurers are those who will create the structure, who will see who is the originator, who would be the SPV, from which credit rating agency that we have to go, and they will structure the entire securitization. They are called as the structurer. It brings together originator, investor, credit, other parties to the deal. These are investment bankers. These are basically the investment bankers, also called as arranger of the deal. And they will make sure that it meets all the legal, regulatory, accounting, and tax laws requirements. Okay, students. Now, let us go to the mechanism, which we have already studied. See, the first part is they will first of all create the pool of assets. Definitely, the originator will create a pool of assets, which is called as bundling. They will combine all the similar assets, all the similar risk return related assets into one pool. Second step, they will transfer it to SPV. They will transfer it to SPV and realize the cash upfront. Third thing is, this is called as unbundling. That also we have studied. In this, the securitized papers or the different securities. See, don't get confused with this securitized paper term. This is nothing but the marketable securities that we have studied. Marketable securities or mortgage-backed securities or asset-backed securities. All of them are same as of now. Okay. So they will sell the marketable securities. That means unbundling. Then there is an administration of the assets. Administration of the assets means regular collection of principal and interest from the underlying assets, and it has to be transferred to SPV. Then if there is a default, then and if in the agreement, if it is mentioned that there is a recourse to the originator, then even the recourse will also happen to the originator himself. Correct? Then lastly, the repayments of funds. The repayment of funds means SPV will repay the amounts back to the investors, and the credit rating to instruments. Before issuing the instruments, before investor invests in an instrument, they will ask for a credit rating for that instrument, which SPV has to undertake. Okay, Rohita is asking, obligators are basis for security when they are secondary participants. Yes. So basically, why they are secondary is, see, very good question, Rohita. I must appreciate the question because, see, if borrowers, we are talking about borrowers or obligors, right? Obligators. See, why they are not primary participant? Who are the primary participant? First of all, primary participants are those whose terms and conditions gets changed in the entire deal or new terms and conditions comes in. But can you imagine for borrower or obligator, is there a new terms and conditions that is coming in? No. So let's say the earlier terms and condition was the loan is for 25 years and the interest rate is 7%. Is it going to change after the entire securitization? The answer is no. It is not going to change. 25 years will still be 25 years, 7% will still be 7%, and 40,000 EMI, what is coming out to be, will still be the same. EMI amount will still be the same after the securitization. And hence, since there is no change in the structure or in the terms and conditions of a borrower or obligator, hence those are termed as a secondary. But on the other hand, if you see for the originator, which is the bank itself, there is a complete change in the balance sheet, P&L, everything will change, right? Because you will realize the amount now, and hence your profit and loss will also change. Similarly, for SPV also, there is an actual giving and taking of the funds. Similarly, for originator as well, and for investor as well. There are new terms and conditions getting created for all of these three, correct? And hence they are primary. Okay, Rohit. I hope I am able to answer your query, Rohit. Hence, they are called as secondary. So the borrowers and obligators are called as secondary because there is no change for them. Still, they have to pay the same amount and still they have to pay within the same time limit. Okay. Yeah, let us go back to the PPT. Yeah, mechanism we have studied. Now, there are two more points. One is the benefits of securitization. Definitely, there are some benefits that we can see, and there are some problems that are associated, or I can say challenges that are associated with the securitization. Now, what are the benefits of securitization? See, we have to study it from the two angles. One is the from the angle of originator. Originator means the bank who has given the loan. Now, first it says that there is a off-balance sheet financing. Why are we saying that this is a off-balance sheet financing? Because we are not borrowing any amount. It is not impacting our debt equity ratio. The once we borrow it, it will impact our debt equity ratio. But since we are just transferring our assets and realizing it in cash, hence it is called as off-balance sheet financing because it is not actually financing per se. It is securitization, what is leading to the benefit. It releases a portion of capital tied up in these assets, resulting in off-balance sheet financing, leading to the improved liquidity position, which helps in expanding the business of the company. Now, what will happen once I get the cash back from the SPV? I can again lend it. I can again give a loan for that. Okay. So this is off-balance sheet financing. Then more specialization in main business. So what it will make sure is that there is more specialization in the own business. So basically now banks don't have to worry or spend their efforts and time in collecting the receivables from the loan accounts. Correct? That activity is now given to SPV or the receiving and paying agent. They will do that. Now banks have already got the money and then they can focus on expanding their business by giving more and more loans because that is what their main business is. Correct? And even the burden of default is also shifted in case of a non-recourse agreement. Correct? Now, helps to improve the financial ratios. This we have already studied that as financial institutions and banks have to report and maintain a lot of ratios. Let's say capital to weighted asset, so our ratio is 1. With this, they are able to liquidate their risky assets into cash and without raising any further amount. So hence it helps them in improving their financial ratios. And also what happens is, now as I told you that in the first slide, now the banks have two options. Here as I told you that banks have two options. One is to borrow money or one is to securitize. Now we are mature enough to understand that this is a securitize, right? Now, one is to borrow money and one is to securitize. If they go and borrow the money, their ratios will also go for a toss. Let's say debt equity ratio and capital adequacy ratio. And apart from that, they will incur a heavy cost because borrowing doesn't come that easy. Always borrowing is at a higher rate and lending it is at a lower rate. If you talk about interbank transactions or borrowing it from someone, the bank will still get higher cost. What we are saying here is, here the cost to receive the funds will still be lower. Hence, there is a reduced borrowing cost. Since securitized papers are rated due to credit enhancement, even they can also be issued at reduced rate. Now, what will happen? Now, students, please note, what we are trying to say here is, in case there is a proper credit report, if there is a proper credit report, let's say AAA kind of a report, it will mean that the risk of investment is low, correct? And what do you expect the return to be? The return expected would also be low. Why? Because in a less risky investment, the return expected would also be low. However, if it is the credit report downgrades the credit rating to, let's say, some C kind of a rating, then risk is higher. And if a investor is investing in that security still, the return also he will expect to be higher. Okay. So this is what it is mentioned here, that in case they are rated and even there is a credit enhancement as well, they can be sold at a lower rate. The securitized paper can be sold at a lower rate, and hence the originator will earn a spread, resulting in the reduced cost of borrowing. So basically, they can say that I will pay you a lesser return. Originator can deal with SPV to say that since risk is low, hence I will pay you a lower cost. For example, bank, which is the originator, it has given a loan at 7%, correct? But it will pay to the SPV only 6%. 1% it can keep with us. And in outside market, let's say he will go and get a loan at 8% currently, but still he is managing to get it at 6%. So that means it has reduced the borrowing cost. Okay. Now, from the angle of investor, who has invested is, there is a diversification of risk. Now, students, please note, once we create the pool of assets, correct? Once the pool of asset is created, and then it is securitized. Now, what can happen is, in this pool of assets, it is nothing but a portfolio only, right? It is a portfolio of loans. This portfolio of a loan will have a risk and return, because portfolios have a risk and return is what we have already studied. Now, it can happen that within this there are thousands of loans. Let's say loan A, loan B, loan C, loan D. They might also have an individual risk and return profile. All the different loans will have a different risk and return. Now, what can happen is, once the portfolio is formed, see, if I talk about as an individual investor means if I talk about as a one investor, what he can do is, he can go and invest in a loan, which is having some kind of return and risk profile. Correct. In this case, is his risk is diversified? No, because he has invested all the amount in a loan. And hence, whatever is the risk and return of that A, it will determine the risk and return of investor. But what has happened after making this portfolio is, at least going back the principles of the portfolio management, where we see that risk is diversified when a portfolio is created. And once the portfolio is created, that entire portfolio of rupees 10 crore is now securitized in 10 lakh securities multiplied by 100 rupees. Correct? So these 10 lakh securities, whosoever holds these securities will also hold the portfolio risk and portfolio return. They will not hold the individual loan risk and individual loan return. And hence, it is diversified, correct? Because the entire portfolio is broken down into the securities. Hence, we say that it is a diversification of risk. Then there is a regulatory requirement. Now, what happens is, now within these securities that are issued, these are backed by the assets, and those assets are what? Those are loans, and those are loans to some kind of a micro industries as well. Now, what banks have a regulatory requirement is to invest certain amount in a micro industry. So instead of investing in a one micro industry, they can invest into a SPV who is holding the funds entirely on the micro industry, correct? Who is issued the asset-backed securities for that particular industry. So that will help them in doing the regulatory requirements as well. Then last point is protection against default. In a recourse arrangement, correct? So now you have to think it from the point of investor, correct? See, in case of non-recourse, originator is benefited. In case of a recourse, investor is benefited. Simple. Because in recourse, investor or SPV has an option to go to the originator. Correct. So hence, in case, this is what we are saying is, in case of a recourse arrangement, if there is any default by a third party, then originator shall make the least amount. Moreover, there can be insurance arrangements or compensation for any such default, is what we have already studied through the credit analysis. Okay. So this is what the securitization concept, benefits, features were. Let me take the questions now. Sairam is asking, what in case of investors and obligators are same? Okay, so Sairam, actually, if you see, if the investors and obligators are same, then the objective of obligator is not met. See, what is the objective of obligator? Objective of obligator is what? Objective of obligator is to convert the illiquid asset that it is holding, which is in the form of mortgage loan, correct? So it has the objective to sell the illiquid assets or the mortgage loan to SPV and to realize the cash now. Realize cash now, correct? And what happens is, these investors, see students, please note, SPV will also keep some money, keep some margins or money, correct, for their operation. Hence, investor will get a definitely lower return than what this obligator was enjoying originally from the borrower. Let's say, let me take an example. 10% is the cost of borrowing, or let's say 10% was the interest rate. So the borrower was giving this originator 10%. Now, since SPV will also earn something, and this originator will also try to, sorry, my bad. I'm talking about the objective of originator here, not obligator. Sorry. Friends, please note this change. We are talking about the objective of originator. So originator have illiquid asset. Let me repeat the entire theme again. So what is the objective of originator is? Originator is having the illiquid asset. Illiquid asset is in the form of a mortgage loan, and that illiquid asset is transferred to SPV to realize the current cash flows. Correct? This is what the objective is. Now, what this originator is currently having is, as a borrower, he is receiving 10% and he will definitely pay here 9%. 1% he will keep, and this SPV in turn will pay only 8%. 1% SPV will also keep. So there is no point that this originator will act as an investor because it will be less lucrative. Now, what Sairam is asking is, can investors and obligators can also be the same? So what he's asking, investors and borrowers can also be the same. See, if borrower have surplus money, they will first repay the amount, correct? They will first prepone the payment. They will not invest it. And if they are getting a better invest, they will invest also. So that depends on the risk and return that they are getting. So basically what Sairam is asking, can borrower and investor be same? Correct. But in this case also, Sairam, if you see, borrower is given 10%, but as an investor, they are receiving only 8%. So still it would be less lucrative for a borrower to investor. Okay. Now, let us go to some of the problems, or let's say the challenges in securitization. So if you see, first of all, the stamp duty, whenever there is a mortgage that gets registered, there is a stamp duty that has to be paid. And in some of the states, it goes even up to 12% in India, because it depends on state to state. And hence, it becomes a less lucrative option to transfer the mortgages under the securitization, because that will also involve the stamp duty. However, some of the states have exempted stamp duty on the securitization of a mortgage-backed security. Now, if you see from the taxation point of view, still, if you see from the, if you imagine for a company and the shareholders taxation is not there, correct? Because the dividend is taxed in the hands of the company itself. Similarly, there is an issue that is going on that is not very clear that who is going to be taxed, whether it is the SPV or whether it is going to be the investor. So there are issues relating to taxation which has to be clarified. Then on the accounting piece, see, if you see this entire securitization is very heavy on the financial instruments. So how to account it, whether in case of non-recourse or recourse, whether to remove the asset from originators' books or not, or whether to realize it properly, how the accounting has to be done is a very big question mark as of now. Although we have to refer the accounting standards for that, India's for that, but still it is a complex. Now there is no standardization across. Now SPVs, they follow their own methods, they follow their own SOPs, there is no standardization of processes. So whatever they feel is good at that moment, they will do like that. Then inadequate debt market means there is no proper debt market where these securities can be traded, or there is not a well developed market which can even be converted into a securities. Correct? It's all over the counter currently, right? Over the counter means two parties sit and they will do the securitization. Ineffective foreclosure laws. So foreclosure means that if the closure of the loan is happening before the stipulated time, the stipulated time was 25 years. If the closure is happening within 15 years itself, then how is the entire securitization going to work? What are the laws around it? Correct? Because if the foreclosure also happens, the bank stops earning interest income and it becomes less lucrative from the securitization point of view. So all these are some of the challenges. Now let us come to the securitization instruments. Now here comes the understanding part. Now, what are the securitization instruments? What are the different type of securitization instruments? This we are talking about SPV, which is issuing securities to the investor. Issuing securities to the investor. Now, these securities is what we are going to study. That what is the nature of these securities? What are the securities consisted of? Now, if you see securities that are issued by SPV, those are of three types that are given in our course. One is the pass-through certificates. Second one is pay-through security. And last one is stripped securities. Now, please listen to this part of the session very carefully. This is also called as PTC, PTS, and SS, stripped securities. Okay. Now, let us start with pass-through certificates. So, students, okay, let me start here. What are pass-through certificates? Okay. Now I'm just cutting the entire value chain short. I'm just putting borrowers here and the SPV here and the investors here. I'm just eliminating all the parties. I'm saying that there are borrowers, there is SPV, there is investors. All the other parties are still there who are doing their own functions. For example, the originator is doing, receiving and paying agent is also doing. So what will happen is essentially the borrowers will pay to SPV and SPV will pay to the investor. I'm talking about the repayment now, correct? Initially, investors have invested in SPV and SPV has given loan, has paid it to the borrowers via originator. But now we are talking about the repayment, correct? So what is the essence of this security pass-through certificate is, now if a borrower pays 100 rupees on principal plus 50 rupees on interest, plus both of them were as per the terms and conditions that in every installment 100 rupees will be the principal, 50 rupees will be the interest, correct? Apart from that, since borrower had some good amount of cash flows, so in one particular installment the borrower has further paid 150 rupees as a prepayment. It has done 150 as a prepayment, correct? Now SPV has got how much cash? 150 plus 50, 300 rupees of cash SPV has got. The entire 300 rupees, the moment SPV receives it, will be paid to all the investors in proportionate amount. Proportionately, this will go to all the investors. This is called as pass-through. SPV, what SPV is doing is, it is passing through. It is passing through whatever it receives to the investors. Simple. This is called as pass-through certificate. Now, some more things to see here. If borrower only pays, this is SPV and this is investor, correct? Now I'm taking second example. The borrower only pays the EMI itself, which is 100 rupees of principal and 50 rupees of interest. That means 150 it gets. SPV will pay only rupees 150 to the investor. So they are matching their cash flows with the cash flow of the borrower. What SPV is doing, they are just matching the cash flows from borrower to the cash flows for the investor. This is what SPV is doing. This is the first case where extra payment is happening. This is the second case where only the payment that is agreed is happening. And this is the third case where there is a borrower, SPV, investor. Borrower pays only 80 rupees in totality because borrower is now defaulting. Borrower has gone out of funds. Instead of 150 rupees, only 80 rupees as a default payment borrower is doing. Now, whatever this SPV has got, it will transfer that 80 rupees itself to the investor. I hope the concept is clear. This is called as passing through of whatever SPV is getting. It is just passing through, that's all. And if you see for investors, from the point of view of investors, at any given point of time, now I'm talking about for pass-through certificates only. For investors, at any given point of time, they will always hold proportionate share in the SPV, correct? Because this cash flow is also distributed proportionately, correct? All this cash flow, if there are, let's say, 10 investors, so to all of them, basis the amount that they have invested, let's say they have invested, all 10 of them have invested, let's say 4 of them have invested 5%, another 4 of them have invested 15%, another 2 of them has invested 10%. So in totality, 100%. So 150 rupees will be allocated in that percentage of investment, or it is 80 rupees or this 300 rupees, whatever is the case. So at any given point of time, any investor, in case of pass-through certificates, will have a proportionate share in the SPV itself, in the assets of the SPV. For example, I'm saying correct shares in the assets of SPV. Okay, this is called as pass-through certificate. We will do a very good example after this. First, let us understand what the. So that's what Sairam, while starting this examples, I said that originator I am skipping as of now because originator will still be there in the picture. So borrower will pay through originator only to SPV. That's how it will happen. But I'm saying because my focus is on these investors, what they are getting is, hence I have taken them into the discussion. Okay, Sairam. This is called as pass through certificates. They will just pass through what they are getting. So what I can say is that pass through certificates in terms of a language is such securities where cash flows of the investor. Investor means the person who has invested in the SPV would be linked directly to the cash flow of the loan taken of the loan cash flow of the assets basically of the mortgages held by SPV. Whatever is the cash flow coming to them at whatever frequency, at whatever interval, that is directly linked to the cash outflow that will be paid to the investors. Now let us go and check the definition once. So pass-through certificates under securitization instruments are those, as the title suggests, originator or the seller of the assets transfers the entire receipt of cash in the form of interest or principal repayment from the assets sold, correct? Thus, these securities represents direct claim of the investors on all the assets that has been securitized through SPV. Simple. So what they are doing is, we are saying that they have a direct claim on whatever cash flows that are coming and even whatever assets that this SPV holds. Correct? Since all cash flows are transferred, the investors carry proportional beneficial interest. That is what we are trying to say. In the asset held in trust by SPV. Okay? Whatever comes goes, that is the concept. And since they have the proportional beneficial interest here, it should be noted that since it is a direct route, any prepayment of principal, our first case, this is our case one, is also proportionately distributed among the security holders. Correct? Further, due to these characteristics, on completion of securitization, once the securitization is complete, correct? Once the securitization is complete, then the final adjustment happens like nothing because already proportionately the assets are getting distributed. And hence all the securities are terminated simultaneously. At one, all the securities will be terminated. Skewness. Skewness means the collection of cash flows occurs in early stage if principals are repaid before the scheduled time. If before the scheduled time, let's say our scheduled time was 25 years. So within 25 years, if we are not getting and most of the investors are prepaying it, in that case, most of the cash flows will come in the starting of the tenure itself. Okay, students, I hope this point is clear. This is what the securitization instruments pass through certificate says about it. Just a second. Then comes the pay through security. And then we will also cover the difference between both of them. Yeah. So Rohita is asking, if SPV transfer entire receipt, then what benefit SPV will receive? Okay, Rohit, I will be covering a specific numerical question on this. Okay, from there we will be better be able to understand what is the concept around it. Okay, Rohit. Now, securitization instruments. The second one is the pay through securities. Let me go back. Now, what does these securities says? Again, I'm going to take case one. So there, these borrowers are there. SPV is there, and third is the investors. Let's say they are paying 100 principal, 50 interest, and 150 of repayment or prepayment. Basically, they are doing some preponement of the payment itself. Prepayment, correct? In totality, SPV got how much? 300 rupees. But SPV will not pay the entire amount to investor, because SPV has a separate arrangement with investor which says that whenever there is a amount due from SPV to investor, they'll always pay at the rate of 200 rupees. That's all. Okay, it is not linked to the amount of collection that is coming from backend. So Sairam, again, I will answer that question whether SPV is getting any income or not through that question itself. Okay, the same question asked by Rohit as well. So I will cover that part. Okay, Sairam. Now, what I'm saying is SPV has a separate arrangement in which SPV says that I am only going to pay 200 rupees no matter what I'm getting. Now, in this case, 300 is the income, 200 is the payment, net is 100, which SPV will invest. Which SPV will invest. Now, take case 2. There is a borrower, SPV, and there is an investor. Again, I'm skipping originator in between, although originator is also doing its role. Now, borrower pays 100 principal plus 50 interest. Okay. What SPV is going to pay is again 200. It is not going to pay 150. Now, if you see 150 is the receipt, 200 is the payment, net 50 is the deficit. This deficit, they are going to cover it from the earlier investment. So what they are going to do is, this 50 rupees is going to come from investment that has been done. Okay, so if you see, the beauty here is that investor will still be secured. Whether SPV is receiving higher or lower, the guaranteed cash flows are there to the investor, which is around 200 rupees. And now let's come to the case third. There is a borrower, there is a SPV, and there is a investor. Now, what borrower gives is only 100 rupees because he is defaulting. What SPV has given to this investor is 200 rupees. So minus 100 minus 200 comes as how much? Minus 100. So again, SPV will realize from earlier investments, which is 50 rupees. And balance, this SPV can also go and borrow, which is divestment, correct? Divestment / borrow. So it has to make good this cash flow of 200. Hence, SPV will do that activity. There's some fog that is coming. Yes, now it is clear. Okay, students. So this SPV is, so what is the pay through security says? Pay through securities say that the SPV cash flows with investors are already defined. Those are already fixed. Those will not change depending what SPV is receiving and what SPV is not receiving. Okay, students. So can I say that cash flow of the investor is linked, is not linked directly to the cash flow of mortgage loan held by SPV. So this is not at all linked to the cash flow that mortgage loan gives to the SPV. It is independent of it. Now, for example, this surplus can be invested by SPV. Okay. If there is a surplus that can be invested by SPV, or in case of deficit, can be borrowed by SPV. So net net, what I'm saying is that investor and SPV would agree to a payment plan which will specify the amount and the frequency. So both investor and SPV would agree to a payment plan independent of mortgage cash flows. Very easy, very simple. Both of them gives you a different perspective in terms of what both of them means. So pay through securities and pass through certificates, I hope are very clear to all of you. We will do one question also, one practical, I can say case study, which will clear the doubts. Now this securitization instruments, pass through certificates, we have already done. So pass through certificates, whatever they receive, they just pass through it, correct? After definitely retaining their operational expenses. Okay, now that is a question from Rohit and Sairam, and even from, it may be from all of you. What I'm saying is the intent there is that they will keep some of the amount as their commission or as their income, and balance they will just distribute it proportionately in pass through certificates, correct? Similarly, okay, I think here in this I have missed the pay through securities. Anyways, the definition of pay through securities is the same. If I just open the, no, I think that's there in the second part. Just a second. Hmm. No, I think I have missed it. The element of putting the pay through pay through security. But anyways, we'll just go through the pay through securities. What is mentioned here? The pay through security definition, as per the study material, again I'm reading it, says is, I'm just starting from the second paragraph. In contrast to the PTC, PTC is pass through certificate. So in case of PTS, which is pay through security, SPV debt securities are backed by the assets, and hence it can restructure different tranches from varying maturities of receivable. Correct? Because why this 200 rupees has come into the picture? Because SPV knows that not all the borrowers or not all the tranches or the different categories are going to give him 100, 150, 150, 150 as EMI. Some of them will give lesser, some of them will give higher. Okay. And some of them will give something else. So hence they know that it is a different maturity. So in other words, this structure permits desynchronization of servicing of securities issued from cash flow generating from the asset. So basically, this is the words that are used, and we have to remember those words. So PTS, there is a desynchronization between what and what? Between the amount required to be paid. Okay. Desynchronization is between two things. One is the cash flow to be paid to the investors, and second one is cash flow to be received from the assets. So Sairam, I hope you are asking about this. You can just copy this if you need. Okay, students. So this is what pay through security is saying. So basically, in pay through security, both the elements are desynchronized. Since in pass through, all cash flow immediately in PTS in case of early retirement or retrieval plus cash can be used for short term yield. Now I will come to this part. Okay. And then we will see the differentiation between both of them. Now, students, please listen to the very basic difference between both of them. Okay. This is PTC, pass through certificate, PTS, pay through security. So students, please note that in case that there is a prepayment happening of the loans, in case of a prepayment, the prepayment will happen to the security holders here, the certificate holders here, correct? So prepayment would be for investors also. In case it happens, the investors will lose interest because prepayment means that I have taken a loan of 40 lakhs and I am prepaying 10 lakh rupees as a bulk. That means now going forward, I have to pay only 30 interest on 30 lakhs. Correct? So that means there is no stability to the return. Correct? There is no stability to the return. There are spikes in the return. Correct. Sometimes the return can be higher, sometimes can the return will be very low because it actually depends on the cash flow. But here, prepayment would not impact. Prepayment would not impact return for the investor or cash flows for the investor, and hence it will give a stable return to the investor. Correct. Because every time the investor will get 200, 200, 200, There it will mean stable cash flow and stable return. Stable return or cash flow basically. Correct, student? So this is what in study material also we are trying to say. So this is what the intent behind both the securities. Now let us come to the third type of securities. Okay, I'll just give 1 minute to note this down. Yeah, let's come to the third type of security, which is the stripped securities. Now, students, please note that all the cash flows that we have just now talked about, like this is a cash flow, there is an interest, and there is a principal. Let's say interest is 50 rupees and principal is 100 rupees. I'm talking about the repayment, correct? The repayment of principal is happening at 100 rupees and interest payment is happening as 50 rupees. These are the cash flows that are coming from the borrowers to SPV. Okay. This is what borrower is paying to originator is paying to SPV. Correct. That's how it is flowing down to SPV. Now, finally, SPV receives these two interest and principals repayment. What SPV is going to do? Now, there is one option with available with SPV is to issue a pass-through certificate or a pay-through security, correct? PTC, PTS. These are the two options that we have already studied. But there is a third type of security that SPV can issue. This is the third type of security that SPV can issue is it can strip this. Strip means it can cut. It can cut the cash flows into two parts. It can say that, okay, one security is IO, one security is PO. IO is interest only. PO is principal only. There are two types of securities that it has cut the entire cash flow. This is the cash flow, right? This is the cash flow. Now the entire cash flow is cut into two pieces. It's stripped into two pieces. One is the interest only and second one is the principal only. Now what SPV is going to do is SPV is going to market or it is going to sell. It is going to market or it is going to sell IO and PO separately. Now SPV will find investors for IO who are only interested in purchasing the interest only strip, and PO. There are certain investors who will be only purchasing the PO. We will come to why part also. Why will some investors prefers only IO or why will some investors prefers only PO, which is principal only? And the prices will be accordingly because see, in IO, SPV will say that to the investor that I will be paying you 50 rupees and PO only SPV will say that I will be paying 100 rupees. So this 50 rupees that SPV will say under IO that I am paying, so SPV will charge, let's say 500 rupees as price, as the initial investment. Similarly, here the price would be higher because we are talking about a higher return, right? Return is 100 rupees. The cash flow will also be higher. The initial investment the SPV will ask to make is 100,000 rupees basically. This 1,000 rupees and SPV will say that, okay, I will keep on giving you the principal that I will keep on getting as 100 rupees. And to the IO investor, it will say that, okay, you give me 500 rupees now. I will keep on giving you 50 rupees going forward later. This is what the IO and PO means. So these are called as stripped securities because these are cut or stripped into two different streams. One is the stream of interest and another one is the stream of principals. Now, students, again, our next point is IO, PO, and then we also have the market interest, which we also called as yield to maturity, right? YTM. So in case the market interest or YTM goes up, in case, let's say the interest rate at the time of issuing the security, issuing the IO security or PO security was 10%. Initial was 10%. Now it has gone up to 12%. In that case, the price of the IO security price also will go up. Why? Because initially we were getting 50 rupees basis 10%. Sorry, this is 50 rupees basis 10%. Now basis 12 rupees, we will get 50 divided by 10 multiplied by 12. This will be higher, which is 60 rupees now, correct? So we will get 60 rupees. That means the price of the IO will go up, the demand for IO will go up, and hence the price also of the IO security will go up, which is the interest only security. On the other hand, if interest rate goes up, the loan amount that currently I am having, I will post pay it, correct? Because as of now the interest rates are up, I will post pay it, and hence the demand of PO will go down, and hence the price also will go down. $100 will go down. Now, the point here to be noted is why it is going down. So now you know that for the price holds an inverse relationship with yield to maturity. Correct. The value of a bond, I think you have already studied it, or it is a very generic principle which says that in case the interest rate goes up, the value of a security will go down. Correct. So PO is nothing but the value of the security on principal. So the principal value itself, the intrinsic value of the principal will go down. Now similarly, if the interest rate goes down, the price of IO security will also go down because now the lesser amount of interest will be realized. It is only 40. 50 divided by 10 into 8 is equal to 40. Correct. Now the revised interest that will be realized is only 40. Correct. Here it will be 10 by 12. So basically, if the interest rate goes up to 12%, the revised PO value which will be assumed will be 83 rupees. And similarly here also, if the interest rate goes down, the price of the PO will go up. Why? Because the people will starting the prepayment of loan. Once the prepayment is there, extra money will come for PO. Once the extra money comes for PO, the return on PO will go up. Hence, the price will also go up. If you see, it will come as 125. This is just don't, I mean, this calculations I'm just putting to show it from the numerical point of view. This is actually not the price going up. This is the return amount I have calculated. Okay. So please be careful while you are noting. These are not the prices of the IO and PO that we have calculated. This is just the direction which I'm trying to say you that this is why, because the return is going up or down, and hence the overall price also will go up or down. So what we can conclude from here is that the interest rates have a direct proportion on interest only securities and a indirect relationship with the principal only securities. Okay. So this is what a stripped security means. Stripped securities are created by dividing the cash flows into two or more new securities, which are IO and PO. Okay. As each investor receives a combination of principal and interest, it can be stripped down into two portions of interest and principal, which we have also done. Accordingly, the holder of IO securities receives only the interest, while PO security receives only the principal, which we have already seen through that example 150. Being highly volatile in nature, these are less preferred by the investors. In case yield to maturity, which is nothing but the market interest rate is increasing, the PO price tends to fall as borrower prefers to postpone the payment on cheaper loans. Correct? That is also what we have seen. Whereas if interest rate in the market falls, the borrower tends to repay the loan as they prefer to borrow fresh loan at a lower interest rate, and hence the value of PO will increase. PO security will increase. In contrast, value of IO security increases when the interest rate goes up in the market as more interest is calculated in the borrowing, that we have already seen. However, when interest rate due to the prepayments, it tends to fall. So this entire 3-4 lines are explained in this small table. This one and this one for IO and PO. Okay, students. So this is explained in the small table. Thus, from the above, it is clear that it is mainly the perception of investors that determines the price of IOs and POs. That is what is stripped securities is. Now, coming to the pricing of the securitized instruments. So, students, if you see, we are not required to calculate the pricing, but we are only required to understand how this pricing works. Correct? We are not required to calculate the prices. We are just required to know that what rate do we use. See how the pricing is calculated. Let me just mention it here, how we can calculate the pricing. See, one, we need the cash flows. Okay, if we know that what are the future cash flows. Yes, Sairam, you're right. IO and PO is also inverse relationship. That's right. Okay, one, we need the cash flows, and second, we need the rate of interest. In the valuation, we will study that the free cash flows are discounted using rate of interest to arrive at valuation. Correct? This is what we say. And this is what I am also saying here. One, we need cash flows, and one, we need rate of interest. So those cash flows we will discount using the rate of interest to arrive at the valuation. What is the correct value? Now, cash flows is one thing which can be estimated only, correct? Using the credit agency's report, using a lot of other things, we can only estimate that what are the cash flows going to be in. The rate of interest is what depends from the perception that we are seeing. See, one is the perception of originator and one is the perception of investor. Let me go back here. So one is the perception of originator. One is the perception of investor. See now, see how originator will perceive. Originator will say that the maximum rate of interest that I am willing to give in this securitization process will be what I am getting from outside as a borrowing. Simple. So originator says that for me, the maximum possible would be the rate at which I can borrow outside. Correct? Because if the originator gives it higher than the outside borrowing rate, then there is no benefit for originator. Correct? Because then originator will go and borrow outside. Simple. Because as we have seen in the first slide, the decision that this bank has to make is whether to borrow money or whether to securitize. If it is going to borrow money and securitize at a higher rate, if he is going to do the securitization at a higher rate, that means it is not beneficial to the bank. Correct? It is not beneficial to the originator. I hope I am able to make the point. So hence the maximum rate of interest that he can go up to for the securitization deal is the rate at which he can borrow outside. So he would prefer to close the negotiation below that. Correct? And for investor, see, for investor, okay, let's first go to the this one. So the from the originator's angle, from the originator's point of view, the instruments can be priced at a rate, okay, at a rate at which originator has to incur an outflow, and if that outflow can be amortized over a period of time by investing the amount raised through securitization. So this line is trying to say the same thing which I've told you in a layman language there, that if they have to incur as a outflow means as an outside borrowing cost, and if that can be amortized by investing the amount raised, that means I am getting the amount today and I can save on that borrowing cost. So I can go maximum up to that rate of that borrowing cost. Correct? Now that is from the originator's angle. Now from the investor's angle, from an investor's angle, security price can be determined by discounting the best estimate of future expected cash flow using the rate of yield to maturity of a security, comparable security with respect of credit quality and average life of a security. Now students, please note, this line is very easy and very simple. What investor will say is that as far as you ask me about my rate of interest, I have a very simple metrics to calculate it. What I will do is, you are giving me a, let's say, security A under securitization, correct? And that security A, you have already given me the profile of that security, correct? That means if it is a mortgage-backed security, within the mortgage-backed security, what is the quality or what is the things? So what I will do is, what this investor will go is, he will go and find a like security, an equivalent security, let's say security Z outside, okay, and he will see that what security Z is offering in terms of yield till maturity, which is what percentage that security Z is giving as a return. The same return I will expect from security A also, because the profile of both the securities are same. If this is offering me a 10%, I will use a discount rate of nothing less than 10%. If I can borrow outside as as 12%, I will pay maximum 12%. Correct? Now, if you see, now this is a matter of negotiation between both of them. Originator says, I will not go beyond 12%. Investor says, I need minimum 10%. So somewhere they will close at 11% after the negotiation. And this will be used for the estimated cash flows to arrive at the security value. This is what we have to study only in case of a securitization pricing. That's all. We are not going to calculate any prices. We have to just see that how and what we have to see here. So for example, from originator's angle, we have already studied investor's angle. Now he is saying that he will use a rate of yield to maturity of a security, comparable security with respect to the credit quality and average life of the security. So the comparable security, security Z, original security, security A. So the same return is expected out of security A. This yield can also be estimated by referring the yield curve available for the marketable securities. Through some adjustments is needed on account of spread point because of credit quality. If now the second part is saying that if we are not able to find the comparable security, then still we can take some security and do the credit adjustment. We can adjust the points there 1 or 2% higher, lower, depending on what adjustments we have to do, and use that rate as a benchmarking rate. Now comes the last point, which is the securitization in India. With this, the theoretical part will get completed. After that, I will solve two examples or the two practical questions to understand better how the securitization work, and we will cover the tranches discussion also, because in features I have left tranches and the homogeneity as 2 points to be covered later. So those two things I will cover now after this. So securitization in India is actually started by Citibank. Okay, so Citibank, they termed the concept of securitization and executed it by bundling the auto loans. Our entire discussion was on mortgage loans, but they started with the auto loans and they securitized them. And after that, government has also introduced an act called Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest, which is called as SARFACI's Act, which is what also you would have studied or you are going to study in the law exam. So this gives the rights, this gives the whose parties which have what rights, legal framework, all those things are given by this act. With growing sophistication of financial products in Indian capital market, securitization has occupied an important place. As mentioned above, though initially started with auto loan receivables, it has now become an important source of funding for microfinance companies. Correct? Because microfinance can get easy finance in this, and NBFCs, and nowadays even commercial mortgage-backed securities are also emerging. Mortgage-backed securities we already know. Commercial mortgage-backed securities is the same thing that we've already studied, in which the asset that is backing the security is mortgage itself, mortgage loan. Correct? The important highlight of the scenario of securitization in Indian market is that it is dominated by a few players, which are these banks. As per a report of CRISIL, it is mentioned that we have crossed 70,000 crores in the financial year 2016 on the securitization transactions. So you can imagine the amount of transactions, the scale of transactions that is happening, and this is even getting doubling now. In every 3 to 4 years, it has doubled. So the recent estimates are almost doubled. In order to further enhance the investor base in securitized debts, SEBI has allowed FPIs also to invest, but only in case of unlisted companies up to a certain limit. So you see now all the measures are being taken. Now there is a proper law in place. There is SEBI also has given the guidelines. We have competent authorities who are monitoring these transactions. So, but still the problems that we have studied are still continuing, which has to be evolved over a period of time. So this is what securitization theoretically ends here. Now let me cover the balance part. Students, please ask any questions in case you are facing, so as to clear the doubts. Okay, now let us see one more case study to understand it better. Now see, students, from the examination point of view, all these topics that we have studied, what is securitization, what are the features, what are the benefits, and pass-through certificate, pay-through security and stripped security, and the pricing part, how the pricing will happen, and the last part we've also studied in securitization in India. So you can expect any question out of this in the examination from a theoretical standpoint. Correct? FPIs means the foreign investors basically. So Pradeep is asking FPIs. FPIs, see, there are two things. FDIs is foreign direct investment, And FPIs means foreign. I'm just not recollecting the exact name. FPIs is the foreign institutional investors, basically FIIs, FPIs. So those are the guys who invest heavily. That the investments comes from outside. Okay. So FDI route is that they will invest and they will. So basically, FDI route is also the investment, and FPI route is also the investment. Okay. So basically, these are foreign institutional investors who invest heavily in the Indian stock market. Okay. So now coming to the case study here. So let me take this pass-through certificate again. The students, please see, it will clarify a lot of doubts that you all are having, that what kind of income SPV will earn, why is SPV transferring all the money to them. So now let us see. So students, now I am assuming that there is a pool of asset that is created, mortgage one, mortgage two, and mortgage three. I'm saying that there is a pool of asset that consists of three mortgages. Mortgages here means that these are the loans. Correct? Mortgage one is one loan, mortgage two is second loan, and mortgage three is third loan. Yes, Naveen, thank you. It's foreign portfolio investor. Thank you, Rohit. So these are foreign portfolio investors. Okay, so they will definitely invest. They will look for good opportunities in India to invest. Okay, Pradeep and Sairam. Thank you, Naveen, and thank you, Rohit. Okay, so these are mortgage one, mortgage two, and mortgage three. I'm saying that these are the three kinds of loans that are bundled in a portfolio, correct? Because the first part is bundling, and the respective principles are also there. Let's say mortgage one is of 100 crores, this is 200 crores, and this is also 200 crores. Okay. So different mortgages have different principal values and different interest values as well. What is the interest value here? 5%, 5.5%, and 6%. These are the interest values. And they have the different maturities as well. What is the maturity? This is for 2 years, this is for 1 year, and this is for also 1 year. Okay. Now all these three we have bundled. Now the bundling has happened, and these three are assigned. These three are assigned to a SPV. SPV is formed to take over all these three mortgages, and SPV has paid 100 crores to the bank who has given these mortgages. Okay. Now, what SPV will do? SPV will raise how much? 500 crores, right? Because 100 is mortgage one, 200 is mortgage two, and 200 is mortgage three. Correct? So SPV will have to raise 500 crores. For this, SPV will issue the securities. Okay. These securities will be issued in denomination multiplied by number of securities will give us 500 crores. The moment the securities are issued, investors will subscribe to these securities, and they will all put together pay 500 crores, with the proposition that SPV have with them is that in the portfolio there are three mortgages, 100, 200, 200, with these interest and these maturity period. Correct? So I think till now the facts are clear to all of you, right? Let me now take the next thing. Now, if you see students, if this is a case of pass-through certificate, correct? Because pass-through certificate means, let's say there are 1,000 investors here. So all 1,000 investors will have a proportionate interest in mortgage one, mortgage two, and mortgage three. This is what a pass-through certificate will entitle them. So percentage proportion would be in all the mortgages, correct? This will be same for all the investors. Depending on the size of their investment, their percentage will be derived. Now, in this, how SPV will give a return to the investor, correct? Because all of them have a different maturity. All of them have a different maturity and a different coupon rate, which is 5%, 5.5%, and 6%. So in this case, what SPV will do is SPV will calculate the weighted average mortgage rate. Please note, student, this is a new term, weighted average mortgage rate. So this is basically pool of assets rate. Very easy to calculate. There is nothing. So we have to take 100 by 500. This is a mortgage one. On that, we are earning 5%. Then second mortgage is 200 by 500. On that, we are earning 5.5%. Plus 200 by 500, which is the third mortgage. On that, we are earning 6%. Correct? So this is just a weighted average based on the amount of loan. Simple. So this is 1% plus this is 2.2% plus this is 2.4%. So this is around 5.6%. Average mortgage rate is equal to 5.6%. Now this is what the income of SPV is actually, right? Income of SPV is this 5.6%, correct? From this, SPV will keep certain operational margin, correct, for his operational expenses. For example, that SPV is keeping 0.6%. So that means net 5% is net pass-through rate. So each and every investor is entitled to 5% of the return. So this is called as net pass-through rate. Now I hope a lot of you were asking that how return of SPV will come. So SPV will retain a 0.6% out of the total 5.6% income and only pass 5%. Hence it is called net pass-through rate. All the investors are entitled to 5% whenever the cash flows comes. And the next thing that SPV will calculate is weighted average maturity, because SPV will have to tell to the investors also that within what time period they will get the money back. They are getting 5%, that is okay, but what is the frequency of getting that 5%? So it is given by 100 by 500 multiplied by 2 years. Then again we are taking just a weighted average here multiplied by 1 year plus 200 by 500 multiplied by 1 year. 0.4 year plus 0.4 year again plus 0.4 year. So in totality, 1.2 years is the total time period on an average basis where the where the investor can expect the return to materialize. Now, what this SPV will say that SPV would propose to investors that they will get 5% return on the investment for 1.2 years. This is what the net underlying thing is. Now, if you see in this is a net pass-through rate that is there, correct? This is how the brief calculation will happen on the amount. Okay. Now, I'm just giving time for 1 minute to note all of you. Now, our last part is left, which is the tranches. What are the what is the meaning of tranches? I will tell you along with an example. With that, our securitization is complete. Okay, now let us go to the tranches. Now, students, please note that what is the concept of tranches? See, while we talk about investors, correct, there can be different type of investors. There is one investor, Mr. A, who is not willing to take any risk, So what he will say is that my risk should be lower and I am okay to settle for a return also to be lower. So he's working on a 3% kind of a return, which is very low. But that is what ideology of Mr. A is. You cannot say whether he's right or whether he's wrong. It is his risk return preference, correct? And there is another person called, let's say, Miss B. Now this Miss B have a risk profile where she says that, okay, I can take higher risk but I have to get higher return. I can't work on boring return of 3%. I need at least a return of 24%. But in that case, she also says that I am willing to take higher risk. What is the risk here? Risk of non-payment, correct? As an investor, if I invest somewhere, what is the risk I have? The risk is that I will not get my money back. That is the risk. Now, as a result, what SPVs have to do? SPVs have to design different tranches. Tranches means different categories in which they can issue different categories of these securities to different investors. Now, hear this out. There is a borrower. There is a SPV. This SPV has given amount to the borrower of 1,000 crores, which is the principal. And assuming 10% is the interest, so 100 crores is the interest that is going to come, correct? Now, SPV has to arrange this 1,000 crores that it has given to the borrowers via originator. I am not going to the originator again. Okay. Now, SPV will say that, okay, let me make 3 categories. Okay, A, B, and C. From A category, let me take 300 crores. From B category, let me take 400 crores. From C category, let me take another 400 crores. Correct? For C category, let me tell them that you will be earning a 6% interest. Correct? These are categories of investors. These are category of securities. Basically, these are 3 tranches of securities. Tranches means there are 3 categories or there are 3 splits, correct? So C, they say that, okay, you are entitled for a 6% return, which comes as 24 crore. B, it says that, okay, you are eligible for a somewhat higher return because the risk that you carry is also higher compared to C. Hence, you get 28 crore here. Then 300 crore, whatever is left, 100 minus 28 minus 24. What is left here? 48 crore. So 48 crore, the balance return all goes to them, which is 16% return. So see, now doing this, what SPV has done is, it has issued 3 kind of securities. It has said that, okay, A, you will get 16, 7 and 6%. And if there is any default, then first of all, the highest secured amount is coming from C. It is highly secured, then B, then A. If finally we have to make something good, then A will have to bear the loss first. You can imagine that A is equity share of a company, B is a preference share of a company, and C is a debt, the secured debt. Correct? How it happens? If the company liquidates or the winds up, then first of all, the secured debt is paid first of all. then preference is given to the preference shareholders, then preference is given to the equity shareholders. The same category or the same tranches, those are three tranches, correct? And hence, this is also a tranche for SPV. I hope I am able to make it very clear to all of you, correct? So these are called as different tranches. Now, what will happen? Now, let me introduce one element here. Now, let's say there is a 10% default. Okay, that means instead of 100 crores of interest, we are only getting now 90 crores of interest. Okay, now how this reallocation will happen? Now, this is how much? This is 100 crores in totality, correct? Now, again, let me put here A, B, C. Okay, so this will still get 24. This will still get 28 crores. The entire 10 crore will go off from here. Instead of 48 crore, now this is how much? 90 minus 28 minus 24. So entire 10 crore. So earlier A was earning how much? 48. Now A is earning 38. There is a high risk. All the risk is passed to A category or to the A tranche. Okay. And what is the percentage here? 12.66 percentage, 7 percentage, and 6 percentage. This is 24 by 400, 28 by 8, sorry, 24 by 400 again, because 400 is their investment, and this 38 by 300 crores. This is their investment, correct? I hope I am able to make the point that because these different tranches have different risk and return profile is different for all the different tranches. Hence, there is homogeneity within one tranche, correct? Within one tranche, there is homogeneity. Within A, all of their proportionately income will get reduced from 16% to 12.66%. This is what homogeneity is. And in practical life, we call this as senior, we call this as mezzanine, and this we call this as junior. Like we call equity, preference, and debt in a company. For a SPV, we call this as junior. Junior are carrying the highest risk and higher return. Mezzanine are carrying the medium risk and medium return. Senior are carrying the lowest risk and lowest return. Okay, students, now let us go and tally what we have studied in the presentation. Now you will understand the meaning of these two, trenching and homogeneity. Portfolio of different receivable or loan or asset are split into several parts based on the risk and return. They are called tranche. Tranche here we have called as A, B, C in our example. Each tranche carries a different level of risk and return. That is also what we have seen. Homogeneity under each tranche. Within A, we are saying securities issued are of homogeneous nature. Homogeneous means consistent. It will be consistent nature and even meant for small investors who can't afford to invest in, who can afford to invest in small amount. Any questions? I'm again very happy to answer, but I think all of you are now able to understand what is the meaning of securitization and how does it works. So with this, our today's session comes to an end. I hope you liked and I hope you enjoyed the entire session. Please do revise the concepts, and yeah, till then, stay safe and keep on revising. Thank you for today's session.